ink has not dried, and there we are making changes. If I look at three things, first is overall from a budget perspective, what one is looking at is fiscal prudence. How are we doing what we are? Our fiscal deficit at 4.4% for current year and 4.3% for the next year does show a fiscal prudence. There is decent amount of increase in capital outlay that the government is proposing. A number of new schemes which are announced, whether it is a 10,000 crores for biotechnology and the 40,000 crores for electronic manufacture. So number of new things which have been announced, all of which are very, very positive, all of which will augur well for the economy. And then we have tax proposals. And if I could break up the tax proposals, I would break them into two broad baskets. And one thing I must admit is that the government was extremely focused on what it wanted to do. So here we were looking at where is the foreign investment coming into. We have data centers coming, we have global compliance centers coming, and the government wanted to say how can it provide certainty to them, and came up with a tax holiday, safe harbor provision, etc., all of which would provide a degree of certainty, degree of clarity, a degree of comfort to investments going into those segments. So a very, very welcome that the government is really focused on those segments. And then we have huge amount of changes which are very welcome because they simplify the law or provide clarity. So for example, when the government goes back and says TCS reduction from 5 and 20% to just 2%. Now, this has been a demand. As a mentor to the FICCI tax committee, I remember having met up with successive revenue secretaries to go back and say, can we rationalize TDS and TCS provisions? TCS is a tracking mechanism, and do you really need a 20% collection for a tracking mechanism, etc.? Lots of changes out there. Lots and lots of changes on amendment to return, the ability to sort of settle matters where one has found not to have filed a right return, whether it is misinformation, whether it is inaccurate information, what happens to in and around that. Very, very interesting provisions out there. Retrospective amendment, and you spoke about it, Arun. Retrospective amendments generally are never welcome. That said, what we are seeing here is that here was a litigation on purely procedural issues, matters with high courts ultimately lying before the Supreme Court, tens of thousands of matters are pending out there, and the government has now come up with a retrospective amendment to put that. And if you look at it, you cannot go into a new law with ambiguities, and therefore I'm glad that those ambiguities have been removed. One last comment before I move on is we got a new law and we said that let's not have alphabets. And for the first time, we have an amendment to the law with an alphabet. So is the law getting any simpler? What will we see in going time will be very, very interesting. But I'm glad that the entire budget has a direction of government wanting to do certain things. And I'm pretty sure it will augur very well. One comment was on securities transaction tax, which spooked the market, and I am no expert on the market. But all that I would say is that, again, a government's desire to say that we are wanting to put a lid on speculation. We do not want features and options out there, and therefore increase in securities transaction tax. As to whether securities transaction tax enhancement is or is not a sufficient deterrent to F&O market, I do not know. Only time will prove that. All that I'm trying to say is that here is one budget where there are these two limbs, simplification and the direction that the government wants, and all the changes that I see are in that direction. With those broad comments, I hand over to Umesh to dissect the direct tax provisions, and then Ranjit talk about indirect tax provisions. Over to you, Umesh.
Yeah, thank you, Arun and Dinesh, for laying the broad context in terms of the budget. As we go through the direct tax provisions. I think one major thing that we need to just bear in mind that we have the 1961 Act and we have the new Act, and as Dinesh has said, that even before the new Act commences, we have a plethora of amendments. We just need to keep in mind that at certain places, largely procedural, they have made amendments to the 61 Act. By and large, no substantive amendment to the 61 Act, and whatever amendments are there, largely on the substantive provisions, they are for the 25 Act, and which is generally from the tax year commencing from April 1, 26, 27. Again, for those who are statistically inclined, we have a Sunday, February 1 budget, and the next February 1 budget on a Sunday is going to be in 37. Many of us may not be there, but that's how things are. So I think before we deal with the direct tax provisions, I think add to comments that Dinesh has made. Government seems to have done two things. One, cast their net very wide when we look at the part A of the proposals, a broad spectrum of the sectors which can generate the GDP growth. They have been covered in terms of specific levies and outlays. There are a few provisions which are relevant from a FDI and deepening the bond market. So as far as the FEMA provisions are concerned, government made an announcement that they are going to recast the FEMA NDI regulations, and one only hopes that the changes are in line with what India needs to get developed as a Viksit Bharat. Similarly, I think again in deepening the bond markets to ensure that the overall cost of capital for Indian corporates is competitive and low. So that's also something which we are going to see specific provisions coming later during the year. Uh, a positive change that has come enabling individuals to invest in India, where the non-resident individual NRI investment, there were two caps, one of 5% for an individual investment and 10% for the overall limit for NRIs. Both the limits have been now increased from 5 to 10, and then 10% limit has now been increased to 24%. Hopefully, this will augur well for non-resident Indians to invest in a market which has shown a lot of growth. And with the trajectory set for Viksit Bharat, one only hopes that the markets will do well, and therefore we should see a lot of participation from our Indian community. Dinesh mentioned that the STT changes really spooked the market. Just as the FM made the announcement, the markets, sort of went into a red. And if you see the budget fine print, there is a mention that somehow the government is wanting to use STT not just as a tool for generating money, but trying to discourage the F&O and trying to make speculative investment. SEBI has come out with reports to say that individuals by and large have lost money, and therefore they're just trying to make it difficult for people to speculate. Next. A major amendment is with regard to buyback of securities. And just to give a context, I think this is one area where we've seen a lot of flip-flop happening over the last few years, where buyback, first it was introduced as a specific levy under a buyback tax, which was only for unlisted companies, then extended to listed companies as well, broadly trying to discourage companies giving out profits to their shareholders and trying to camouflage dividends as buyback and capital gains. A year back, or in 24-25, we had the amendment where again there was a sea change where buyback provisions were so any buyback was treated as dividend and the corresponding cost was allowed as a capital loss. This really shook up the entire market, and as professionals we were trying to reconcile how to best reconcile to this major change. So we have now a significant amendment which has come for buyback of securities, where broadly what the government is trying to say is that buyback of securities will now be taxable as capital gains. But there is a catch here. Promoters, whether listed or unlisted, they will end up paying a higher capital gains than the scheduled rate. So if public shareholders in a listed company and minor shareholders who are non-promoters in an unlisted company, they will pay a normal capital gains. Promoters of a listed company will pay higher tax, and if the promoter is a company, then the tax rate applicable is 22% and 30% for a non-corporate promoter. So I think the die is now cast in such a way that public shareholders get protected in terms of a capital gains tax rate, and promoters to discourage use of buyback as a substitute for dividends, they will end up paying almost a tax rate equal to the dividend. There'll be some juggle in terms of the definition of promoters, where what they have said is that SEBI buyback regulations, the definition of promoter under the SEBI buyback regulations will be applicable. And for unlisted companies, we'll have to look at the definition of promoter under the Companies Act. And there is also a reference that people who are directly, indirectly holding more than 10% in an unlisted company, they will also be covered under the definition of promoter. If we just look at the corporate history, who gets regarded as promoter has been matter of significant debate, and I think that debate is going to spill over even as far as the applicability of buyback tax. Hopefully, we just hope that the current buyback provisions stay for a longer time, because every few years the flip flop is never good for both corporates and tax professionals. Uh, As far as MAT is concerned, again, a major change. And what we've seen over the last few years is that the government has, for individuals, old regime, and there was a nudge from the government to by and large push the individuals into the new regime. There is also a similar old regime applicable for corporates. And this time, I believe it's not a nudge, it seems to be like a strong push by the government to by and large push a lot of corporates into the new regime. So if you look at how the MAT provisions will apply for corporates, there is a reduction in the MAT rate from 15% to 14%. Again, I don't see any reason why a 1% change has been considered. But a major change which will impact, and as we go through the provisions, it appears to be on the positive side. So all companies who are under the old regime, so if you have a backward area unit, and therefore there was a sunset applicable to the most of the backward area incentives, which by and large the sunset is 31st of March 26. If you had a unit in an SEZ where there are continuing benefits available, so companies under the old regime, and what I said at the beginning, there seems to be a strong push. And if you see how the provisions are, I think it will be very evident about what the strong push is. That for domestic companies who don't move to the new regime, for them, the MAT tax is the final tax. And corresponding to that, any MAT or tax liability paid under the MAT. So if you have a normal tax which is lower and a MAT tax which is higher, you pay the MAT tax, you don't get any credit whatsoever. Uh, to encourage companies to move to the new regime, there are two benefits, and again we need to just go back into a little bit of history. So earlier, a lot of corporates, when they moved from the old regime to the new regime, we have handled a lot of situations where people forego, they had to forego their MAT credit. Now you have a golden period available where if you are moving to the new regime, you have to make a elected choice in terms of whether the old regime is beneficial or a new regime is beneficial. And there are a handful of cases where the old regime may still be beneficial, but that's an individual competition that every company will need to do. But once you move to the new regime, instead of losing the entire MAT credit, you will get the MAT credit, and that MAT credit will continue for a period of 15 years. But they have only put a limit in terms of how much MAT credit you can utilize in a financial year. So you calculate your tax liability, and if you have a MAT credit, 25% of your tax liability you can offset against your uh, uh, by way of a MAT credit. So if you have your tax liability of 500, 25% of that is 125. If you have a MAT credit of 300, then you offset 125, balance 175 you will be able to carry over. And this 25% limit you will have to adjust year to year. Therefore, some corporates may be able to get the benefit of MAT credit utilization in year one, a few others in some extended period. So by and large, when we are looking at some of the companies, this will be ETR accretive for a lot of corporates because bad credit, they will be able to move to the new regime, also utilize the MAT credit, and again, depending upon their overall tax liability, it could be in a shorter time frame. For foreign companies, by and large, because there was no dual regime applicable for foreign companies, so the MAT credit provisions by and large stay on the same lines. Uh, Again, IFSC, I have been making this comment that, like the Taj Mahal, which took 20 years to be built, IFSC regime, we've seen over the last 10 years incremental changes. But this year, the government has done certainly a big bang change. So, all the existing and the new IFSC units, which are currently entitled to a 10-year tax holiday exemption, that 10-year limit has now been extended to a 20-year period, which is a big signal from the government that they want the IFSC regime to become solid. And I think this is a major initiative from the government that at one stroke the 10-year limit has been extended to 20 year period. Also, a small clarificatory amendment that after the tax holiday period is over, you get the current 10 year was within a period of 15 years. The 20 years is now over a period of 25 years. So within a block of 25, you have to elect the 20-year. And for the residual period, instead of a normal rate, you pay a concessional rate of 15%, which is again positive. A major, technical issue has been clarified, and when we were looking at the IFSC regime, there was, and if you see all the tax holiday units, there is always a provision to clarify that if the unit in a tax holiday sector is set up due to splitting up or reconstruction of the business, then you are not entitled to that benefit. And this was missing as far as the IFSC units were concerned, and therefore there remained a fear in the mind of tax advisors whether we could see this coming through later in terms of a fine print or in terms of how the courts will react to a tax holiday benefit. Now they have clarified that from the next tax year, any IFSC unit, and this will cover by and large all the types of IFSC units which are entitled to the benefit, that if the unit has been set up due to splitting up or reconstruction or from transfer of existing assets, then you will not be entitled to the tax holiday regime. Uh, As far as business provisions is concerned, I think the first one, while it appears to be an innocuous thing, seems to be a big benefit. Under the current provisions, a company receiving contribution from employees under ESIC, PF, or similar funds. As far as the employee contribution which the company receives, the applicable due date was the due date specified under the fund, which was a shorter window, and we had litigation, and the litigation was decided against the SSC. Government now seems to have sided the corporates to say that as long as the payments is made within the due date of filing of the return, then you will not suffer a disallowance, because that disallowance was like a cliff disallowance. Even if you pay one day late, you cease to get the entire benefit of the employee contribution paid to the respective fund. One is reminded that there is an existing Supreme Court decision in the case of Allied Motors, which has sort of held that whenever such clarificatory provisions come to remove an hardship, those have a retrospective effect. There is certainly a lot of litigation around this settled against the taxpayers. One will need to go back and see whether the Supreme Court decision in the case of Allied Motors could still come to the rescue for all the past years. As far as uh, I'll come to the second last bullet that, for rare earth minerals has been something which has been talked in terms of US-China trade-off, tariffs, and how government wants to ensure that India has a lot of security around the rare earth minerals. So for any exploration activity around specified minerals, and there's a list of those minerals where if you've incurred the expenditure prior to as part of prospecting or prior to commencement of actual exploration, then you'll get it over a 10-year period. Again, positive change. Yeah. Dinesh mentioned about government trying to look at tax certainty, and I believe there is as far as tax certainty is concerned, on transfer pricing, government seems to have given a very strong set of provisions to ensure that foreign companies, whether they are in electronic manufacturing or for GCC, there is lot of litigation around what is the applicable transfer pricing rate for some of those cost plus sectors that foreign companies set up in India. To clarify and to try and ensure that there is the transfer pricing litigation is significantly eliminated, government has done two things. One is that the existing limit, which was 300 crores of turnover, has now been increased to 2000 crores, and therefore larger set of companies will be able to move to the safe harbor regime. What the safe harbor means is that once you offer income at the specified rates under the safe harbor regime, government will not look into any detailed litigation and any justification. And if you see that the existing rates, which were all different, right from 17 to 24%, they have come out with a rate of 15.5%, which by and large is the rate at which most of the advanced pricing arrangements have got settled. So again, sizable benefit to bring in certainty as far as transfer pricing is concerned. Again, I think one other limb where a small provision which has come more by way of an announcement is that uh, if we've seen last few years, while there is a APA regime and a lot of agreements keep on getting signed, but there was no outer limit, and you see a lot of APA filings not getting settled. So the government is trying to bring in a 2-year regime, especially for the IT service sector, to ensure that all the APS get signed. Again, this is an announcement, and one will have to ensure that procedurally the tax department lives up to the wishes of the finance minister. A small provision, again, very helpful, is that whenever you have an APA, and by and large, in a lot of the cases, there is a related party which is associated enterprise on the other side. Now, once you have an APA, the company which has filed for the APA will recast their returns on the basis of the APA. A corresponding amendment in the applicable tax filings of the associated enterprise was a lacuna. They have clarified that whatever is the APA sign, the other side will also be able to take the benefit of uh, the applicable tax rate. So I think there is again certainty as far as transfer pricing is concerned. On penalty, a lot of changes have been introduced, and I will sort of clarify this when I deal with the penalty. But I believe again this is largely in line with trying to decriminalize penalty provisions, trying to put some of the penalty which were all percentage of turnover to a fixed capital, fixed amount. And again, without going into details, we will deal with when we deal with the penalty provisions. Dinesh mentioned that, and again, I would want to spend a few minutes, and this is more to sort of educate tax professionals and the tax paying community. Um so far as professionals, we were always used to, looking at the fine print in terms of all procedural aspects are concerned. And you had the Supreme Court decision in the case of Ashish Agarwal, and thereafter, Rajiv Bansal. And what we are seeing is that government when they have brought in the faceless scheme, when they have moved the provisions from the 61 Act to 25 Act, wherever there are procedural gaps, and the tax department is not usually updated or as updated as far as the procedural aspects are concerned, and therefore the tax advisors and the corporates take benefit of the lapses on the part of the tax administration. And some of those litigations were positively settled by various high courts, writ petitions, and a lot of matters have moved to the Supreme Court. Supreme Court has also given some positive recommendations. So if we look at the entire basket of litigation around tax demands, which are largely settled in favor of the SSC on account of procedural issues, I think the government seems to be saying that, no matter whatever you believe is the fine print reading on the tax provisions, as far as procedural matters are concerned, they have brought in, and as Arun mentioned, a lot of retrospective amendments have been brought in to ensure that, and some of the retrospective amendments go back till 2007, 2009, 2021. So by and large, all procedural aspects on transfer pricing, where you had what is the time limit for passing the final order in case there is a reference to a TPO. They have again clarified and put this in the form of both changes to the 61 Act and changes to the 25 Act, and therefore we will not be able to take a benefit of procedural lapses. As far as DRP order references were concerned, we had the decision in the case of Roka Bathroom, which also, by way of a retrospective amendment, the government has clarified. Coming back to a topic which is favorite to tax professionals and the tax-paying community, and this is a small but a significant change. I think the government is conscious of the fact that, for moving India to the Viksit Bharat, government needs to do a lot of land acquisitions to develop various zones for manufacturing, various zones for specific zones for industry, and there is a parallel land acquisition process which is there. We had the right to fair compensation and transparency in land acquisition, and that law provided that any acquisition pursuant to this law, there will be no tax liability in the hands of the SSC who surrenders the land. This was by way of a specific provision in the relevant act. Now they have codified this to say that this will be an exempt transfer and therefore no tax liability. And this there was a CBDT circular clarifying this, but now we have certainty because a specific amendment has been made. On the sovereign gold bond, and we've seen the last few months where gold and silver, they have really been the darling of speculators and the investors. So on the sovereign gold bond, they have clarified to say that if you had subscribed to the sovereign gold bond, and there were different series that were announced, so the government has clarified that all the series will get covered. There was a tax exemption which was available, which was on redemption, and there was a possibility for somebody to buy the sovereign gold bonds from the market and surrender it at the time of redemption, which is on the final maturity of the scheme, and still claim that the redemption premium or the surplus was not liable for capital gains. They have now clarified that any sovereign gold bond, if you have invested, you need to be in the scheme right from the beginning, which means that only if you hold the SGB right from the beginning till the final redemption, then you will get the exemption. And if you have acquired it from the market, then you will not get the benefit. As far as the other changes are concerned, again, a clarificatory change where they have clarified that, if there is a pre-acquisition interest, then there is a current limit of 2 lakhs which is applicable for interest on self-occupied property or on let out property, or in certain cases of a let out property, and that pre-acquisition interest will also get covered within the 2 lakh limit. Small clarification on the Motor Vehicles Act to say that any interest. So as far as the compensation is concerned, while there is no provision in the law, but most of the courts have taken a view that any compensation is not taxable. But now they have clarified that any interest for delayed payment of the compensation, that interest will also not be taxable. A major change which is possibly covered in the first bullet, and I dealt with the third bullet first, is on interest deduction for dividend income. And this is something which could impact a lot of investors, including individuals. But I would possibly want to deal with the cases of corporate investors who make strategic acquisitions through largely leveraged. You borrow, and then out of the borrowed funds, if you make the acquisition, the current provisions say that any dividend income is taxable under income from other sources, and there was a limit of 20% for interest. Now that limit of 20% towards interest, whether it is dividend income or income from mutual funds, the entire 20% limit has been removed. On first blush, this may appear that this will be significantly negative for the corporates who are doing strategic investment, but we believe there is a possibility for corporates who are making strategic acquisitions to try and possibly see whether the borrowings could be eligible as interest on borrowed capital, and therefore covered under provisions of section 36, but subject to a little debate and subject to a little fine print analysis on whether 36 versus income from other sources, which is the zone applicable to you. The law seems to be clarifying that no deduction against uh, dividend income or income from mutual funds. Uh, I think something that we need to have said right at the beginning is that by and large there are no changes to the overall tax rates. So barring the changes to the buyback regulations and a certain set of exemptions that have been provided, the tax rates remain the same both under the old regime as also under the new regime. Dinesh mentioned about TCS, and there was one provision where TCS under LRS was provided at a very high rate of 20%. So overseas tour packages, now they've clarified that depending again upon the size of the spend. So if the foreign remittance is up to 1 million, then there's a five the existing rate of 5 and 20% has now all been blended into a uniform rate of 2%. For other LRS remittances, and largely there were a lot of students who were making loans for education, taking loans for education purposes. And as Dinesh mentioned, that the whole objective of the government was always to try and keep track of uh, the LRS loan payments and whatever is the TDS applicable, and therefore a very high headline TCS rate was considered to be largely discouraging genuine tax assessees, and therefore they have brought it now down to 2% for education, and again 20%, which is, I believe, an obnoxious rate that continues for other purposes. There is a whole list of TCS applicable on a lot of agricultural and forest produce, and they've rechecked the TCS rate. Will not go into the fine print on that. Small clarificatory change on supply of manpower, and whether supply of manpower could have been regarded as professional or technical income, and therefore liable for tax at a higher rate. They've clarified that TCS, I mean, TDS provisions for supply of manpower will be covered under the existing provisions of Section 194C, and therefore subject to 1% for individual recipients and 2% for others. There is, if you look at the procedural aspects, there are two provisions that seem to be made, and again, this could benefit small taxpayers. One is that, for small taxpayers, if you want to take the benefit of lower TDS, then you had to physically file a form, and the AO had to make your assessment and clarify whether a lower TDS is applicable. Now, the details are not yet announced in terms of what is the limit for small taxpayers, but they have clarified that this will be done electronically, and therefore one hopes that the process will be set in such a manner that more people will be able to get the benefit of lower TDS pretty seamlessly. Uh, a major provision again which will help a lot of small taxpayers who are receiving dividend income. Uh, Under the current provisions, I had to file a declaration for each company where I had invested. If I am eligible for receiving dividend income without any tax deduction. Now they have clarified that all that I need to do is file it to the depository, and the depository will then possibly file it to the respective company. So the headache both for the taxpayers as also the companies possibly is trying to be simplified. One will have to wait for the fine print to understand how this will actually take shape. Government has, as far as tax returns are concerned, and one, gets a little spooked, as far as the tax deadlines are concerned, because this is a provision where they have recasted the tax deadlines, and this has been done from the current financial year. So we are in the month of February, and end of March when the current financial year closes. So the tax deadlines have been modified for especially the non audit cases where the deadline of 31st July has been extended to 31st of August. But I believe there is a procedural gap where, as far as trusts are concerned, charitable trusts are concerned, where the deadline, so they have said this is a beneficial change, but I believe that, for trusts, the earlier deadline of 30th September now gets preponed to 31st of August. As far as the updated return of income is concerned, again, we have to keep a perspective in mind that the government wants more voluntary compliance, and in a lot of cases, the government has been able to generate a lot of additional tax revenue by linking, the entire data. So there is a lot of data analytics that's happening, and under that, data analytics, if the government is able to track a lot of your financial transactions, a lot of notices flow to the taxpayers, and wherever there are gaps in terms of actual transactions versus what the return filing has been done, most of there is a facility for filing an updated return. Uh, Now, under the current provisions, if you had a return of loss, then there was a blanket bar that you could not update a return. A lot of the taxpayers, they represented to the government to say that, if I have filed a return of loss at 100, and if I find some error in my return and I reduce that loss to 50, 60, I should be permitted to file the updated return, which government seems to have understood and reconciled to this. Therefore, even if you have a loss return, as long as the loss claimed is reducing, you should be able to file an updated return. Uh, A major change, which can be seen is that, under the current regulations, if there is a reassessment proceedings which are pending, and the reassessment proceedings will start moment you receive the notice, you were not permitted to file an updated return. Now the government seems to again be giving a little bit of nudge that if there is a reassessment proceedings that has been initiated, then before the reassessment proceedings actually commence, you get the opportunity to file an updated return by paying an additional 10% tax over and above the existing rates. I'm not very sure whether this is a positive change, because people will try and sort of arbitrage between not filing and then waiting for reassessments and trying to take the benefit of a lower tax outgo by getting this window of opportunity by filing an updated return. So one will need to see how this actually works out, but generally should be positive for taxpayers. As far as the undisclosed foreign assets and income are concerned, and this to give some perspective, this is an outcome of the Black Money Act, and under the Black Money Act, there are requirements for residents uh, to ensure that they completely disclose both their foreign assets and foreign income. And moment there is any non-disclosure, that entire non-disclosure is liable for significant penalties, significant hindrance in terms of both penalty and prosecution under the Black Money Act. So there is a one-time scheme, and the details of the scheme are likely to be announced, which is trying to provide a voluntary disclosure for, I would say, non-disclosures which were not punitive in nature, and therefore, largely in cases where ESOP holders, they have not disclosed those ESOPs held in foreign companies. So if I'm an employee of a foreign parent, and the ESOPs have not been disclosed, you could try and get your cases covered. If you look at the details of the scheme, it covers two types of situations. One is if there is undisclosed foreign assets or income, uh, you end up paying. So this is like a opportunity that you will be entitled to pay tax and a penalty, which is 100% of the tax, which is another 30% plus applicable surcharge. And if there are a few instances where the income is disclosed, but there is a non-disclosure as far as the asset is concerned, then you will be able to regularize your matter by paying a fee of 1 lakh. In such cases, and there is a immunity granted for penalty and prosecution as well. But just to clarify that the immunity from penalty and prosecution will not be applicable where there is a notice under the Prevention of Money Laundering Act, or where a prosecution proceedings have already been initiated. So as long as there is a voluntary compliance without the government without the government catching you, then you will get a window of opportunity to get out of the rigors of the Black Money Act. Um, I think these are largely procedural, but I will sort of clarify. And again, this goes back to what comments I made, that as far as assessment timelines are concerned, um, you know, government introduced a faceless scheme. There were reassessment notices issued under 148, where the notices were issued by the jurisdictional assessing officer. And thereafter, because the reassessment proceedings were covered under the faceless scheme, then the entire process was done facelessly under the faceless scheme. And a lot of tax assessees, they filed writ petitions in various high courts, and by and large, a significant amount of the high courts were in favor that the entire reassessment proceedings were covered under the faceless scheme, and therefore the jurisdictional assessing officer never had the ability to issue the notice. Now, what the government seems to have clarified is that it was always the intention, and if you see how the process, as thought by the government, was that the jurisdictional assessing officer will do the inquiry. He will try and determine whether the case is getting covered for reassessment. And once the reassessment notice is issued, then the next set of proceedings will be done in a faceless manner. So you have a retrospective amendment which clarifies, and there is a litigation which is pending before the Supreme Court, as clarified earlier during this presentation, that possibly the Supreme Court may not hear those matters, because once the finance bill becomes the act, I think then at least the die is cast against the taxpayers. So Jao versus Fao, no benefit available at all. Uh, I think the last bullet I have clarified that wherever there are procedural defects, I think we will not be able to take benefit of procedural defects, and therefore, especially in situations where there are multiple number of cases, large tax amounts involved, lot of litigation, I think that the tax paying fraternity will need to be mindful that even if you do a lot of hard work trying to you get positive decisions at the lower courts, the government is going to put a lid on your benefit by making retrospective amendments. So whether Arun, I would want to hear whether this will sort of change the behavior of the taxpayer, especially arguing on technical aspects.
No, I don't. One of your good friends told me once that wherever we can take a chance on technicality, we will. So, yes, and I do think that the constitutional validity of these amendments also will be challenged. I don't think the taxpayers will give up so easily. And there's a reason for that. You look at a Supreme Court judgment on shelf drilling.
Hmm.
Where is it that the core that they differ, the two judges? That one judge, Justice Satish Sharma, who wrote the lead judgment, he said that 1.35 lakh crore of lost tax is at stake as per the government. And therefore, it is important that such technicalities are not brought to the fore. Uh, Whereas Justice Nagaratna felt that 1.35 lakh crore in lost tax should not be a consideration. We are here to decide only law. But if just that one issue, as per the government, involves 1.35 lakh crore in lost tax, uh, shelf drilling plus Jao Fao plus DIN plus Pfizer, all put together could be in the region of 2 to 3 lakh crore. Will they let a procedural infirmity invalidate 3 lakh crore of tax assessments? Impossible. Now, can you get away if these four were not together? Had it been one of them, the stake was maybe a few thousand crores, not this magnitude, then I think the government may have reacted differently and brought in something prospective. That's my sense. I think it's the amount at stake plus the collections being very tepid and flat. I think the overall circumstances.
Yeah, so I think you can always try your luck, and if your situation is a isolated situation, you could still get. But if you are part of a large number of SSCs and a huge tax demand, then just keep in mind that all your effort is like a contingent gain. Finally, till the tax department has the final say, you will never know the outcome of any favorable decision at the lower level. So on block assessments are concerned, I think the existing provisions, they say that the time period of 12 months run from the last date when an authorization is completed. And in most of the cases, the such provisions, they are always at a group level, and therefore, if there are multiple authorizations or multiple POs for large number of SSCs, there used to be litigation around what is the last date, because your whether it has to be with reference to the date applicable to a individual SSC or as far as the group is concerned. So the government seems to be clarifying that the time limit for completing a block assessment will be from the date of initiation of the search. And to take care of procedural aspects, the 12-month period has been extended to an 18-month period. As far as the tax on the unexplained cash credits, investments, money, expenses, they have got rationalized from 60% to 30%. But I think this is not a reduction because there is so they've sort of modified the provisions to say that instead of an existing 60%, it will be 30% plus a penalty if it is and all such cases will be treated as misreporting of income, and therefore there is a penalty of 200%. So 30% plus 60% at twice of the 30%. And plus if you apply the surcharge, then the total amount shoots to somewhere higher than 115, and therefore again clarificatory provision, but to sort of clarify that any cash credits which were earlier covered under provisions of section 68, 69, we still not got used to the numbers as far as the new act is concerned. So misreporting, they will be treated as misreporting, and the higher penalty will apply. As I clarified that, so the first aspect is with regard to addition on account of unexplained credits, which will be treated as misreporting, and therefore the misreporting penalty, including 200%, will apply. As far as there is a immunity that is available for any assessment that is completed, which was currently available only for underreporting of income. Now they have extended this to misreporting of income. So for even if there is an addition on account of underreporting of income or for misreporting of income, you will be able to take benefit of immunity. Different rates apply, but as long as you exercise the window, then you will both the situations get covered. A major change, which I think a large sector, the entire corporate sector needs to keep in mind, is with regard to complete change in terms of how penalty provisions become, at what stage the penalty provisions are initiated and penalties levied. Now what the government seems to be saying is that the tax department was finding it difficult to keep track of assessment and penalty provisions. So what has been specified is that uh, when the AO does the assessment, he will also pass a penalty order. And therefore there will be a consolidated demand which will be raised. As far as the penalty demand is concerned, the penalty demand will not be enforced. So the interest meter on the penalty demand will start only after the CIT appeal is disposed of against the SSC, and if it's a DRP, when the ITAT order is disposed of against the SSC. A favorable change, but because the penalty will be levied as part of the assessment order, possibly a contingent liability disclosures for corporates will increase, which is something which corporates will need to bear in mind. A favorable change is with regard to the payment of demands in assessment. The current limit of 20% has been slashed to 10%, and mind you, the penalty amount is not even subject to, so there is no recovery on the penalty amount. So this 10% is on the quantum addition. Yeah, I think I'll skip the other changes. We still have time. Yeah, we have indirect tax provisions, so we'll deal with some of the procedural. We can come back. We can come back. Yeah. Again, decriminalization of tax offenses, simplification, making the life of taxpayers more easier, has been a standing mantra of this government. And if we keep it in spectrum with changes that have happened under the Companies Act and a lot of the other fiscal and economic laws, I believe that there has been a significant change in that same direction, where prosecution provisions, there are a set of favorable changes for the prosecution. So wherever there were rigorous imprisonment, those rigorous imprisonment has been reduced to simple imprisonment. The period of 3 years to 7 years has been reduced to 2 years. So a lot of positive changes with regard to rationalization of prosecution provisions. I will not really want to go into the fine print because the number of prosecution cases are not so very high, but you will just need to look at the modified provisions when we deal with any prosecution cases. I think as far as NPOs are concerned, again, two provisions that need to be kept in mind, that for general public utility, there was a cap of 20%, that if a charitable organization which is engaged in a GPU activity, there was a limit of 20% which was applicable. Now, if there was any violation, then there was a possibility of the NPO losing exemption. Under the 25 Act, there was a fine print reading where, in such cases of violation, there was a possibility of the NPO losing eligibility for status as a charitable organization. And they have clarified that in such cases, they will not lose the exemption, and therefore the tax liability on the basis of gross assets, those will not be applicable. So again, a positive change. There's also a change with regard to merger of NPOs, which again I will possibly want to skip given the time constraints. With this, we have a few minutes left for any question and answers, but I'll hand over the further proceedings to my partner Ranjit on the indirect tax provisions.
Thank you, Umesh. I'm just going to first mention, the point which you raised to Arun on procedural aspects and litigation and demands concerning things like DIN and such points. So even in the context of GST specifically, customs as well, there are quite a few proceedings where the departmental authorities have generally managed to put the DIN into the document that they issue. But there are several documents which we've seen and they don't have the DIN for that matter. So whatever is the sort of amendment which we will look at from the direct tax point of view, I think there could be a impact point from a indirect taxes point of view. Having said that, moving into the proposals that we have for GST first. Now, since we've had the GST regime, the changes have, of course, been recommended, or the proposals have been made as part of the recommendation by the GST Council. And in September of 2025, we had GST 2.0, where several rate changes were made, several other amendments were also proposed. Giving effect to some of those proposals, there have been amendments that are now proposed in the finance bill. And there are specifically three of them which are prominent and which are pertinent that we should discuss now. So the aspect of valuation, where we are concerned with post-supply discounts, it could be reduced from the taxable value, assessable value, if it was linked to the invoice and a pre-existing agreement, and there was reversal of ITC by the recipient. The proposal is that the issuance of credit note by the supplier with the corresponding ITC reversal by the recipient is the requirement. Therefore, the linkage with a pre-existing agreement and the invoices is no longer going to be a critical aspect that has to be met by the taxpayer. The next amendment which is proposed is also concerning credit notes and therefore valuation. So the credit notes which were issued hitherto were not directly linked to or were not in respect of discounts, because the provision concerning it in section 34 did not have a specific reference to discounts. And this specific reference, which was not existing, is now sought to be brought in into section 34. So the proposal will expand the provision to include credit notes which are for and in respect of discounts. The big one is, of course, the place of supply on intermediary services. This has been a matter of a lot of debate and controversy and litigation. As the provision stands, the place of supply is the location of the supplier. However, this is to be amended as per the recommendation. So it will be the location of the recipient. What this means is that exports from India of services will not have to have a GST implication or GST payment, whereas the import of services, which is brought into India, will have a reverse charge tax that will have to be paid. And of course, subject to the provisions that are applicable to a taxpayer, the credit of that can be taken. Now, the valuation and the credit note related provisions will have to have amendment made in the state GST Acts as well. So therefore, the date for this to come into force will be a date that is notified or will be notified. As far as the amendment concerning intermediary services is concerned, it's going to be effective from the date of the finance bill as and when it receives the assent of the president. One aspect that has come up is whether there is a retrospective effect that can happen or can take place in the context of intermediary services. That's something that we will need to wait and watch. It's possibly a view that some may want to take. However, it does not seem from the current text that it would be supported. There are certain other recommendations, and these are more in the nature of sort of relief for the taxpayer. The primary one is concerning is concerning inverted duty structures, where 90% of the claim of refund for by a inverted duty structure taxpayer will be provisionally allowed, as was the case for exports. Customs was something that was supposed to be or was expected to by India Inc. and tax professionals alike to have a series of a large set of proposals. That has not been the situation. In fact, the most prominent one in the case of amnesty was expected by the department. An amnesty scheme was expected and in respect of customs matters, like there was for income tax, like there was been for VAT, like there has been for service tax and central excise. However, that has not come, and that's a sort of dampener in a way of speaking. However, the focus of the proposals or the entire amendments that are proposed in and through the finance bill has been to improvise and simplify processes, automate to the extent possible, such that there is reduction of timelines for clearances of goods and imports into India, exports as well, and there is a ease of managing and completing all the compliances that are in respect of the customs law. So that's the focus, and that's where you will find a lot of the amendments are actually sort of referenced in terms of a process or in terms of regulations or in terms of filings, in terms of timelines, etc. But the key legal amendments that are there, in terms of Section 28, there was a provision, or there is a provision for payment of penalty at the rate of 15% of the duty that has been charged. And this is in the case of situations where there is collusion or suppression or willful misstatement. Now, the proposal that has been introduced is to indicate that such payment of 15% would, as and when it's made within the parameters as has been prescribed, would be treated as a payment of related to or in respect of the duty which was not paid, so as to not color it and taint it as penalty. This seems to be a point that has emerged upon representation from industry, and also I'm told that there were certain difficulties in renewals, such as in AEO licenses, where if a penalty was paid, it became a hindrance and a roadblock for AEO accreditation. So this amendment that is proposed would be helpful in addressing those problems and situations faced by the taxpayers. The other amendment that is there in Section 28J concerns the validity or the tenure of an advance ruling, which today is 3 years, is proposed to be extended to 5 years. This will be a useful one in the sense that there will be consistency and a continuity for 5 years, subject, of course, to no factual change or no change in the terms in which the advance ruling has been pronounced. There will be a case for a taxpayer or the party who has sought the advance ruling to make an application, and upon request, the tenure of such advance rulings will be extended if they are in the case of those advance rulings which have been delivered. There is a important sort of process or procedure oriented amendment in Section 67, wherein the requirement of the proper officer to allow and permit the movement of goods from one warehouse, one bonded warehouse, to another bonded warehouse, including water mover regulated units, is to be done away with. So it will be based on the rules and the regulations, and not based on and after the permission of the proper officer. Certain other legal amendments that are proposed in the context of fishing and fishing related activities are important only from the point of view that they enhance and expand the territory of India for the purposes of and limited purposes of fishing and fishing related activities. So beyond the territorial waters, which is 12 nautical miles, if there is an activity conducted by a fishing vessel, which is Indian flagged fishing vessel, there will be an implication for it to pay import tax. There will be an implication for it to be demonstrating it that there is an export of the goods, and thereby sort of have the status for each of these type of events. Another procedural one, but a big one, I would say, is that in the context of authorized economic operators, AEOs, which is in tier 2 and tier 3, there was a duty deferral scheme which was already in effect. So if you were to make an importation between the 1st and the 15th of the month, your existing liability date to pay discharge the liability was the 16th of that month. Whereas if you imported between the 16th and the last date of the month, it was the first day of the next month. Now, these are all sought to be collapsed into one sort of date line, which is the first of the next month, where you are making an import between the months of April and February. In the case of March, it will be the 31st of March. So in that way, there is a enhanced time frame which will be allowed to a taxpayer importer. Such duty deferral scheme and facility will also be extended to a new category or a new class, which is the eligible manufacturer importers, for which the criteria will be prescribed. The finance minister's speech did mention about genuine concerns of passengers in international travel being faced during and in respect of baggage claims and allowances. And for that reason, we are now going to have new baggage rules 2026, which will be effective from the 2nd of February, which is tomorrow. And these regulations will comprehensively revamp the existing set of rules. The other benefit that has been extended by the government is to support the SEZs. Now, we've seen SEZs being set up, but so far there is a capacity underutilization. There has been a sort of situation where SEZs have been existing where they have not supported India exports or Indian manufacturing and exports. So as a one-time benefit or concession, the SEZ units can supply goods into the DTA, the domestic tariff area, at a concessional rate of duty, of customs duty, which otherwise would be applicable at the full rate of customs duty to those goods. So this concessional rate will be available based on certain regulations, restrictions, and a sort of limit that they have to prescribe. Quickly turning to some of the tariff-related changes on the customs side. Goods which are imported for personal use will see the rate go down from 20% to 10%. There will, of course, now also be a social welfare surcharge, SWS, which will be applied to these. Effectively, the rate does go down for these goods which are under Chapter 90, Tariff Heading 9804, but they will now have a SWS as well. In keeping with what happened in Budget 2025, where there was rate reduction from 25 to 40% to 20%, and rate reduction for 100% to 150% levy to 70% in a large set of line items. There were removal of several exemptions or modification of several exemptions and extension of the social welfare surcharge on 82 line items. We now have a situation of continuity where the basic custom duty rate for 54 tariff entries, including food items, mineral, coal, etc., will be rationalized and the corresponding exemption will be omitted. Effectively, the duty rate will remain the same. At the same time, we have 33 new tariff entries that are going to be introduced. These are not there in the existing tariff that we have. Either they will be classified as other in the given tariff entry, or they would be, in some way housed in the residuary category. So we'll now have 33 entries which will be introduced, and this extends to battery separators amongst other goods. The revamp, in a way of speaking, continues. There's customs exemptions and concessional rates, where the BCD is extended to certain products, including goods for sodium antimonate for solar glass manufacturing, which are in solar generation power projects. Exemption or concessional rate for 107 items, including in gold doors and leather footwear, etc., are to be extended to 31st of March 28. Certain conditional exemptions on 23 items, including in the case of silicon wafers, will lapse out on 31st of March 2026. Unconditional exemption on 11 items, including laboratory reagents, shall lapse on the 2nd of February 26. Sunset clause is also been mentioned about for exemption for certain specified gold and silver products, which is door bars, bars, jewelry, which has been set as 31st of March 2027. The basic custom duty exemption on capital goods that are needed for the manufacture of lithium ion cells for batteries, which are battery as an energy storage system, which is a new sort of sunrise area for India Inc., is going to be granted as an exemption. The BCD exemption on parts or of aircrafts, including engine for manufacture of certain aircraft parts, will also have the exemption subject to certain rules. Social welfare surcharge, retaining the effective rate of social welfare surcharge, there have been amendments proposed in certain exemption notification. So by doing away or rehousing them or amending those, the effective duty rate remaining the same, certain amendments have been made or have been proposed and will go into effect from 2nd of February. In the case of parts of electronic toys, an exemption from the SWS will be granted effective the 2nd of February 2026. Similarly, in the case of AIDC, the Agricultural Infrastructure and Development Cess, amendments are made due to the rate notification and due to omission of certain exemption-related entries that are there in the tariff. There is no change specifically in the context of the AIDC rate. Central excise, of course, now a very, I would say non-issue, but from the perspective of the products that have a national calamity contingent duty, which is levied on a capacity basis, the rate has been enhanced from 25% to 60%, which is chewing tobacco, jarda, etc. For the levy of additional excise duty on unblended diesel has been deferred to 31st of March 2028. Those are the key proposals or the headline proposals in respect of indirect taxes. But it's also important to sort of appreciate the capex related support schemes or incentive proposals that have been made in the speech today, which will sort of give a boost to or will look to augment India, make in India and Indian manufacturing. So we have the biopharma strategy for healthcare advancement through knowledge, technology, and innovation, Shakti scheme, which has a 10,000 crore allocation. An India Semiconductor Mission 2.0 to promote equipment, material design, and supply chain for manufacture of semiconductors. The outlay for electronic component manufacturing scheme, which was at 22,000 odd crores, has and will be enhanced to 40,000 crores. And that is a big one since a lot of Indian manufacturing are looking at this scheme to delve into it and to carry out manufacturing of the electronic component in India. There's a scheme to support states in establishing 3 chemical parks. A construction and infrastructure equipment scheme is also talked about in the speech today, and a container manufacturing scheme with an allocation of 10,000 crores to create globally competitive container manufacturing ecosystem is also important from the support that it will extend for the shipping and the logistics sector. So these are the key incentive related schemes that we had. I'll take it back to you, Arun.
Yeah, I think
before Umesh Bhai has to run a slide on data centers.
So I think just as the slide is getting presented.
Yeah, let's just hold on for a minute until then. There's a lot of discussion on the retrospective amendments. I can see many questions as well on the retrospective amendments. Some interesting questions on the buyback and capital gains proposal. as well. We'll take some of them. We may not have all the answers right away, but we'll still try and take those questions. Just hold on for a minute and we'll restart the presentation. Yeah, here we are.
Yeah, so I think one of the questions which sort of reminded this particular aspect is that there's a major provision which is covering data centers and electronic manufacturing support, and I think the data center part is a big one. We all know that data is the new gold, and come AI, and you have so much of data center activity in terms of chips, and given the current regulations in terms of data localization. The government wants to create an incentive for foreign companies who are offering cloud-based data center activities. So there is a 20-year exemption, and I think this is a big one because a 20-year exemption has been provided for any foreign company which is rendering data center activities, again cloud-based, through an Indian company, again under a notified scheme, where the foreign company avails the benefit of a India data center company which provides services to the foreign company. So what is provided is that there's an exemption to the foreign company, and as a result of which no implications either as a PE or any FTS related regulation, but they will have to do these activities through an Indian company. So we expect that there's a lot of data center activity going on in India, and this is going to give a further impetus and create a certainty in terms of foreign companies trying to use India infrastructure in terms of data center activities. Government last year had recognized that there is a need for enabling. There's a lot of iPhone manufacturing and a lot of electronic good manufacturing activity which is shifting back to India, and the necessary professionals for those activities need to come from outside of India. So any such professional who comes in, he becomes a resident. There is a provision clarified that as far as that professional is concerned, his global income will not be taxable in India. There is also a clarification with regard to electronic manufacturing, and again, these are specifics where a company like Apple or any foreign electronic manufacturing company, it avails buyback from an Indian company, and if it provides capital goods which are placed in a bonded warehouse where the capital goods are used for the purpose of manufacturing under a buyback regulation, then the income of the foreign company will not be liable for tax in India. So these were provisions which we sort of skipped in the presentation, but Arun, now over to you for taking up the questions.
Yes, we could possibly close the presentation. Yeah. Umesh, the first question is for you. Will accumulated MAT credit as on March 2026, can it be carried forward under the old tax regime and utilized against the tax liability from the next FY, that is 26-27?
Appears to be a clear no. I think, as I said, the government has pushed all companies having accumulated MAT credit to move to the new regime, and you can't carry forward your MAT credit under the old regime. The only way you can carry forward your MAT credit will be to move to the new regime and then be subject to a utilization of MAT credit at 25% of your tax liability. If you continue to remain under the old regime, MAT becomes your final tax and no carry forward. So as far as the old regime is concerned, virtually MAT credit seems to be dead.
Yeah, the next few questions are on buyback. Uh, the first one is the additional income tax proposed in case of buyback for promoters, especially non-residents. Would the credit of such additional tax be read as capital gains and be available as credit in resident jurisdiction? Or could this be treated as tax other than capital gains?
Because this is a tax on the underlying income, and therefore I don't see any challenge whatsoever. The credit will be available to non-resident, because this will be liable for capital gains. You pay the tax, and if the income is taxable in the foreign residence country, then a credit will be available. I don't see a challenge.
Yeah, this one is also interesting. On continuing on capital gains, what is the definition of promoter in unlisted companies? For example, will say the wife of a promoter, if she has no board position and if she invests from her own income sources, be classified as a minority.
Well, in a lighter vein, I might want to say that wife sometimes can be calling the shots for the promoter, but uh, I think whatever is defined as promoter under the Companies Act, and if the holding is moved to a set of people, they have clarified that directly or indirectly. If the holding is in excess of 10%, then they will be regarded as promoter. But I do believe that there will be some ambiguity in terms of how the additional levy for promoters will apply, and therefore there will be effort at the level of taxpayers to try and wriggle out of the additional tax by trying to get out from the classification of promoters.
Actually, we do have to classify promoter holding in the company for the company filings every year, the annual filing. So the question is, how many of them change that filing after these amendments? So
Yeah.
it's not that those we don't know who the promoters are, because you have to file with the Company Affairs Ministry every year, if I'm not wrong.
Yeah, so I think if you already filed, and in the case of companies that have gone listed, so you have a lot of the startup companies, and again I will not take names, but a lot of the promoters who had classified themselves as promoters before they filed the DRHP, they wriggled out from the category of promoters, and possibly a similar exercise one will need to justify even for unlisted companies. So as long as you are able to move out of the technical definition both for listed and unlisted companies, this additional levy will not apply, but a lot of effort and fine print analysis will be required to justify.
And do the provisions apply to domestic company who has opted for new tax regime 4 years back?
Yeah, I think, and so yeah, if it is with regard to the buyback provisions, the buyback provisions will become applicable irrespective of whether you are under the old regime or new regime.
Okay, what's the difference between rigorous imprisonment versus simple imprisonment? It's about maybe how the court does it, or rigorous imprisonment maybe for a particular period or so. But that's a good question. But what essentially the government is saying, that the court, we are empowering the court at its discretion possibly to convert a simple imprisonment into fines slash fees.
No, I think what the change in the prosecution provisions are, that wherever there was a provision for rigorous imprisonment, barring a few cases, by and large the rigorous imprisonment has been reduced to a simple imprisonment, with also a corresponding change in the period. So we need to just check the fine print whether rigorous imprisonment still continues, but I think as applicable at first cut, there are no rigorous imprisonment provisions, but we'll need to check the fine print where rigorous imprisonment still remains on the statute.
Yeah, Ranjit, I think this is for you. Why clause 141 related to intermediary doesn't have an effective date while all other clauses have?
Yeah, that's an interesting one, and I somewhere somebody suggests it's a drafting lapse, perhaps. But as we see it, it's a omission, and therefore, as the Finance Act will, as in when the Finance Bill will convert into a Finance Act and have the assent of the President, it should come into effect. Also, it's part of the integrated GST Act, and the states will not really have to do much on in that case. So, as we understand, the omission will take force or will take effect from the date the Finance Act becomes an act and applicable. They could have clarified, but strangely.
Yeah, Ranjit, this is also for you. Any tax incentives or duty exemptions specific to exploration and drilling activities? Anything today?
I've not caught anything in the speech or even while glancing through it, but we'll have to get into a little bit more of the
Sure.
fine print to answer that specifically.
Yeah. One more, can penalty on account of deficiency of service by customer, can it be claimed as credit note under current GST and a discount? It's not related to budget, right?
No, it isn't. It isn't.
Okay, fine. So then there are roughly 60 more questions, Umesh bhai. So I just took a few. I'm conscious of time. Rest is now up to your discretion.
Yes, I'll just deal with two questions. One which is consequent to the change in the buyback provisions, where for any buyback, under the current regulations, there was a view possible because the entire buyback proceedings were treated as dividend, and under the proviso to the capital gains section 46A, the consideration for the buyback was treated as nil, and therefore there was a possibility to claim that section 50CA will not apply, and therefore if the buyback is happening at below the applicable valuation rules, then the difference could have escaped any sort of a levy. With the buyback provisions being changed, now provisions of section 50CA will again spring back, and therefore if the buyback is happening at lower than the applicable tax valuation rules under 11 UA, then that difference would be subject to tax. There's a small issue where penalties are converted to fees, whether they become deductible. Again, one will have to try and look at that. But I believe on prima facie, it appears that if it's not a penalty or a fine, and if it's compensatory in nature, then the case for a full deduction becomes higher. With this, I think we will sort of close there. There are a lot of questions we can't deal, but a Sunday evening, a massive budget with 120 odd amendments, and I think credit to the entire team for making the presentation. And if there are any fine print gaps, we would sort of clarify at a later point in time.
Absolutely, Umesh bhai. This comment from a participant actually captures everyone's sentiment. Sincerely appreciate this webinar, and thanks to the learned speakers for highlighting budget provisions in simple words. This has become the go-to webinar for participants. Almost 1,500 participants today with Zoom and YouTube. We were full on capacity for Zoom. So sorry if we were not able to accommodate many of you, but hope you all were able to view it on YouTube as well. Many thanks to Dinesh bhai, Umesh bhai, Ranjit for the wonderful exposition in just under 4 hours on union budget proposals. So much to chew on. We've definitely not had the last word on the budget proposals. We all need to see how the stock markets react tomorrow. I am not going to close with any title track of any movie, but yes, Dhurandhar is the flavor of the season. The stock markets definitely do not think so. All eyes will be on the stock markets tomorrow, 9:15. If past is prologue, do remember that governments in India have been very, very sensitive about how stock markets deal with the budget. Today has been possibly the biggest thumbs down to any union budget from the Modi government in the last 12 years from the stock markets. If they continue on that trajectory tomorrow, all bets are off when it comes to further amendments before the bill is passed. On that note, thanks once again to experts from Dhruva Advisors. Thanks to everyone for this participation and great response and questions. Look forward to seeing you all again on another budget webinar. Thank you, everyone. Have a relaxed Sunday evening going forward.
Thank you.